High five, everybody. This is Gil from the Fivers, and we want to start today a new series of 5 chapters, 5 sessions, where we're going to discuss in depth about supply and demand theory, that concept that will explain to us almost every particular movement that is happening in the market. Um, there's a lot of stuff to cover, but first let me know if you can hear me all right, so we can start. Perfect, perfect. Also, I'd like to know from you if you have any background or understanding or knowledge about supply and demand. Just write it down because I'd like to know on what level to talk to. A little bit, 20%, yes, no, a little. Okay, so we'll start from the very beginning and from the very basics. And during the 5 seminars that we're going to do every Tuesday, same time here, we will do a recap on the basics, and then we'll proceed on to the more advanced material. So let's just start and we'll all know what's going on. So okay, so we're going to talk about supply and demand, also known as order flow theory. This particular theory is a unique way of looking at charts and reading from these charts the narrative that is happening in the market. What we're trying to achieve with supply and demand analysis is to actually try to learn what are the participants of the market are looking for, what they are about to do, what hints they are telling each other through the sign language of the charts. And if we can read these signals, and if we can read the narrative of the story of what's happening in the market, we would be better off trading with higher edge. Supply and demand is a theory. It's not a trading style. It's not a trading strategy. It's a reading technique, a technical reading technique, and you can use it with any other trading strategy that you're already doing. It's a complementary view on the market. It can be also standalone. I'm using it as a standalone because for me, it's telling me enough about what I need to know. But you can use it with any other strategy. So it's not contradicting anything that you know by now. It's only adding more view, more insight on the market. And what is supply and demand? Supply and demand is something that is the very core of what moves the market. And while I'm saying the very core, it means that it's so universal thing that it will never be broken as long as the market that you are trading in, it has enough of liquidity. If it's high liquidity market, like Euro US dollar, like gold, like Apple stock, these assets which have a lot of liquidity, they will react well enough to give us an edge to the laws of supply and demand. And the core of what makes price move is very simple. When there are more people willing to buy than people willing to sell, price will move up. If there are more people willing to sell than people willing to buy, price will go down. This is the very basic of everything, and that will help us to find good opportunities to buy the assets for cheap and sell it for expensive. And that way, we are always trading the extremes, and we have a very improved risk-reward ratio for this. We will also teach you how to cherry pick high probability trades, and that will give you a lot of accuracy in predicting what the market will do next. And like I said, it can explain what and why the market moves the way it is. In a way, supply and demand is very commonly used with price action, candlestick patterns, and chart patterns because it's a price indicator. It means you don't need anything else to read it but just looking at price. So today we're going to look at naked charts, and we'll try to tell ourselves what was the story until now, and knowing the incentive and the intentions and the motivation of the participants in the market, we can decide on what direction and from what particular price level we would want to trade. So let's do some commercial. It's going to be very quick. My name is Gil Ben Hur. I'm trading for 14 years. I'm an independent trader, used to be an independent trader. I used to be a portfolio manager, a private one for my family, for a private clientele. I used to have a very big and well-known trading community with a premium trading education program. At 2016, I founded the 5percenters.com, which is a funding traders and growth program, mostly for Forex traders. That's about this. Let's do supply and demand. So I'll talk first on the concepts, so you will have a visual way of seeing what is supply and demand. So I have 4 types of illustrations for you. So bear with me if you already seen it. If not, try to understand what I'm trying to say. Okay, so supply and demand is a universal law. It doesn't particularly related to the financial markets or to charts. It is for every market. If you think about it, think about your street you're living in, and think about the real estate in it, and think about how price had changed in the past decade. You would notice that if your neighborhood had a high demand, price went up on that neighborhood. If there was some issue with the neighborhood, I don't know, a factory came around, or I don't know, they found pollution, or people are migrating from a certain, because the neighborhood is getting old and not really invested by the city, then price will probably go down. It's all about the demand and the supply. It's all about how much people are willing to sell houses and how many people are willing to buy. So at the end, the core universal law of supply and demand is matching two two intentions: one to buy and one to sell. So if we're looking at these two pictures, we see on the right side, we see a store with a lot of products on the shelves, but no clients coming in. There are the owner of the store is paying salary for all these three people, and he already paid for the rent and for the stock on the shelves. Now he needs to get rid and justify all this business-wise. Okay, so what happened? What do you think the store owner should do if people not coming into to his store? Maybe he would make a discount, and in that way he would drive more people in because they think they have a good opportunity, right? So what is a discount? A discount is taking price down. You would always take price down when you have too much storage that you need to get rid of. So you are willing to reduce price so people will come and buy it, right? So this is case one. On the left side, we see a lot of people coming into a store, and much more people than that story can actually contain. In that situation, that store owner can take advantage of that and sell whatever he sells for higher, because he see how much motivation there are for the people willing to buy. He can increase the price until people will stop coming, or until he clear all his inventory. Okay, so this is one illustration of what is supply and demand. And if you think of the financial market, it's pretty much the same. We'll talk about it. Okay, so a trade in its essence is when two sides agree upon quantity and price. Every price, every tick that you see in the market, and every deal that you see in life, whether it's buying tomatoes, buying real estate, or buying financial contract, it's about two sides. One is buying and one is selling, and they agree on quantity and price. So the thing is to look at this balance of buyers and sellers, and we have three broad situations that we have in the market that will come to the desk of the exchange manager, and they will have to decide. They're doing this automatically, but it's a decision for what to do in order to create more volume and to satisfy the participants of the market. So the exchange will receive a lot of orders for the people that's willing to buy, for the people that's willing to sell, and they will match them. And everything will be with a price, and they will see if they can match sellers and buyers all together. So the first situation is what we call a balanced supply and demand. When we have enough buyers and enough sellers and everybody is happy. The sellers are selling their supply, the buyers, they are receiving their demand, and nothing changed. We have enough matching between the buyers and the seller. So that will create a price not to move. If we take it to our to charts, we would the interpretation, the graphic interpretation of this is ranging. We'll see price ranging at around certain range. That will be our indication for a balance in price. It's very important because everything begins when there is balance. And then we have the next scenario where more people are willing to buy limited supply. There are more people willing to buy limited supply. This means there are demands exceeding supply, right? So what happened there when there are more people asking for limited stock? Price will go up. It will go up until there are going to be a balance between buyers and sellers, until there's going to be a balance between demand and the commodity, the inventory. Okay, this is where price will go. So if you think about the balance scenario, that will be where we know for sure that there is enough buyers and sellers at that point. So that is going to indicate for us on the future that this is where people, both participants in the market, the buyers and the sellers, are happy. Okay, the third scenario is when supply exceeds demand, when there is much more inventory than our willing buyers. Okay, there is no incentive to buy unless price will go down to be at a cheaper price. Once it's going to be a cheaper price, it will become an opportunity and more buyers will come. So price will slide down all the way until they're going to be until price will be at opportunity price for more buyers to come, and then price will return to balance. Okay. Another way to look at this, to illustrate what's going on, is what is actually happening on the exchange desk. Imagine that every file that you see on both files is represent an order. On the right side, we see orders that participant wants to sell. They want to sell that commodity. Let's say it's a Facebook stock. Okay, it's the share of Facebook. So at certain price at the exchange, there'll be this amount of participants submitting their orders to sell Facebook stock. The left side will be people willing to buy this stock at this certain price. What will the exchange will do, and this is very easy to picture this graphically. I'll take my if the exchange will start from top to bottom. Sorry, from the first, they will match first to first, and they will create this deal. Remember, every deal must have a matching buyer and sellers that agree on a certain price. So we're talking here about a price level, and the exchange is now taking these orders that are piling on their desk, and now they are matching sellers to buyers and buyers to sellers. So they're doing so until there are no more sellers to go. What happened to all these buyers? These buyers, we call them unsatisfied buyers. They don't have anyone to sell them the product they are demanding. What is that situation, Taylor? What is this scenario? It's demand exceeding supply. And what happened when demand exceeds supply? Price rise, price going upwards. Okay, the same thing, the same scenario goes on the other way. So just imagine this, visualize this. Every time you see price going down, every time you see price going up, you actually see a representation on charts on candlesticks that is actually this scenario that is happening on the desk of the exchange manager. Okay, so let's see how it works on charts, how we see all these two illustrations, three illustrations that we're discussing. Let's see how it's being represented on the chart. It's very, very easy, right? Very straightforward. When price is moving down, there is sellers exceeds buyers, right? Because price is going down. When price is ranging, this is where buyers and sellers find enough a comfort zone where they are dealing and they're making enough trades, and then price remain at the same area, right? The same range. So, and then when there are no longer buyers willing to buy, price must go and find cheaper prices and slides down and go and drops. And where it drops to the next base area, the next area where price is basing. Now, at around this bar, there are more buyers coming and there are less sellers. What happened? Price is coming up. Where it's going? To where they can find more sellers. And here they find enough sellers for enough time, and they're dealing and they're happy until there are no more sellers and price go down, basing up, basing a little bit up, basing again and dropping, basing and dropping, base and drop, rise, rally and base, rally and base, rally and base, rally, and etc., etc. This is the story of the market, right? It's very straightforward. I didn't teach you any secret just yet, okay? But we can see this in the naked eye, and that, and now with the same chart, I'm going to show you how we actually trying to take advantage of this story that we just told ourselves. So first, we have to be a little bit more precise, diving deeper into where was that particular time, where was that particular price where buyers exceed sellers or sellers exceed buyers. We call that that price, that key level, we call it a decision point. So we have a routine where we would want to find that decision point. So first, to find a decision point, and this is also very, very easy graphically, we are going to look for places where price had dropped before, okay? Everything we do, all the analysis we do is based on the past, okay? And we'll know later on in just a few minutes, you'll know how to take advantage of this, okay? How to trade this. So very easy to find these drops and these rallies. Every time you see an impulsive bar, this is where buyers exceeded sellers or sellers exceeded price. Okay, so we just mark them. Let's just mark these. Okay, so we mark the drops. We mark the rallies and the drops and the rallies and the rally and another tiny drop and a rally and drop. Okay, so very easy, right? Now we want to find a very precise price where we assume that the scenario that we are talking about, these two piles of orders where one of them was eliminated and there are no longer one side existing at a certain price. Where is that particular price? So if we think about what candle represent, and I believe most of you, if not everyone, know how to read Japanese candlesticks. But if we look at this, we see that price has gone up all the way, and price was closing down right about here. From that on, price was starting to drop. We can assume that this area, that the bottom of this reversal pin bar was that decision point. So we will mark this as the decision point where from that on price is originating the drop. You don't see, do you think that, do you see the red rectangle, everyone? Yeah, okay, so it's not frozen. Okay, good. So, so that would be the decision point. Now, when we've marked that decision point, remember, it's price, and price doesn't have diagonals, it doesn't have moving averages. Price is price, okay? At a certain price, where at the exchange, let's say at price 1.1, there are no longer buyers in it, but only sellers. There are few unfilled sell orders left at the desk of the at the exchange desk, right? So where that would be, we believe it's going to be right about here, where we see the reversal and price significantly convince us with the eye, with the naked eye, that price has originated a convincing drop of price. Okay, that would be our decision. Okay, so what we're going to do, because it's price, we're going to extend that level, that decision point level, the decision level. We're going to extend it all the way to the future. Okay, and because we are now in an educational session, we will see what happened once price came for the first time to a decision level where we assuming that there are unsatisfied sell orders waiting at the desk of the exchange. Okay, remember that image. Okay, so at the decision point, we're going to extend it all the way to the future until we meet price once again. Okay, so what happened when price breaching for the first time to that decision level? If you're looking at this on a very precise manner, price is reacting to this decision level and reacts. Okay, now it's time to say something. It's not a reversal. We're not predicting reversal. And we're not predicting anything. We assume, because we have the picture in our head of what is happening last time price had left that price level. Okay, we remember what is happening, what is left at the desk of the exchange at this price level. Okay, so once price is reaching to this area, what happened? There are buyers coming and they're willing to buy, and here there are unfilled sellers waiting for price to come back. And once price come back, they match. They have that deal. They trade. Okay, there's enough sellers on this particular price level that is actually creating a reaction in the market, and that creates that zigzag at the minimum. And it can also evolve a reversal, but not just yet. Okay, we don't know that for sure, but what we can assume is that with high probability that once price come for the very first time to a fresh, untouched decision level, we can assume that there's going to be a reaction. And trading is about risk management. We would want to trade wherever we have the best odds to succeed, but we're always managing risk. So this place would be the place where we would take the least risk, as much as we can understand this, by selling from here and hoping not for a reversal, but just for a reaction. So how to be realistic with the goal here, we're not talking about this just yet, but this only to illustrate how we create our entry based on a decision level, while we're picturing what's actually happening on the exchange table. Okay? So why did I draw here a rectangle? That will help us to actually manage risk, because we have the decision point, but we also have here another significant high. What is that significant high in terms of supply and demand? If you try to think about this, this high is where we had the last seller matched with the buyer, okay? And from that on, price was going down, okay? This means that we don't have enough buyer's strength in here. This is why price went down, very obvious, right? Below, above that very top, that very last trade that was in this recent history, there we don't know what's going to be here. So in order for us to define a risk, we would put our stop just above this tip, because here we know for sure that there are sellers and not enough buyers. So at that peak, at the peak of the week, we know there were more sellers than buyers for sure. This is another key level that defines to us, that tells us that there is an imbalance of supply and demand. So if we would want to sell, we would know that there are sellers existing here and there weren't enough buyers to fulfill their. So the same assumption applies for the whole zone. So if we are looking for a sell, we would want to sell from the decision point, but we will leave a room for error, or a room for things that we don't know or we cannot know, and place our stop loss just above that peak, because below, above that, we don't know what is going to be. Okay, so that rectangle is creating for us the risk zone. We call it at this particular scenario, we call it the supply zone. So the whole zone is where we actually configure our stop loss, and this is where we manage our risk. Okay, so the whole zone range is our risk unit, and so this is how we actually build our trade. I think I jumped a few slides on this. So the same thing as we've done our supply zone, we can do the same thing for the demand zone. We are going to see where price is reversing. We're going to look at an impulsive bar, and where that bar had started picking up and making some significant, this is where will be our demand decision point. The low of that week, this was the last recorded trade, and we know there are much more buyers than sellers in here, therefore price had spiked up, right? So we will build our trade, we will structure our trade with entry at the decision point, risking this whole zone, and our stop loss will be just below this, okay? Same thing here, we see price coming down. The last trade was right here below, and price was deciding to go up from right about here. So this will be our decision point. So now let's look what happened when price is arriving for the first time to that zone. We see that price is actually reacting to that decision point and reacting. Okay, it's a reaction, not reversal. At this particular, we don't know if this is a reversal because we need to see the bigger picture. But we see enough range for price to go. Also, we can see that on this particular situation, we see that the second time price was reacting to this level. But what helps us help price to be supported and pick up higher is another demand zone that was created on top. Every time we see price bounce, it's a supply and demand decision point on a micro level or a high time frame level or whatever levels. Price is price. When price deciding to go up, we assume there are leftovers there. So we have this clean demand when price is coming back for the first time, then it reacts and giving us enough. And then price is going upward, reversing. So we know that we mark the decision point just below for a drop, and then price is going down. And when it's approaching back for the very first time, look how precise price is reacting to that decision point. It's all about supply and demand law that is actually a universal core rule for every market, whatever it is. Okay, so let's talk about how we build our trade. Very simple. So, like I said, on the decision point, we will set our buy order. Usually it's a buy limit. Just imagine that from this line, after it was formed, we don't, the whole chart that we see here is not existing. Let's just imagine that this is the presence right here. We see price rising up. We have a demand zone. We are looking for the first time to buy. When price approaches that demand zone, we would buy. Again, this is for education's sake, so you get the whole story, okay? And next, what we're going to do is to do it on live charts, and then you can see for yourself through the week how it's going to happen. Okay, so we place our buy order at the decision level, and we're waiting for the first time ever for price to come back. We will not take the second time price coming back, only the first. Okay, our stop loss will be just below. Okay, the potential reward that happened. I'm not saying that we would know how to take this as a TP, as a take profit, but look how much price would go after the first initial reaction to fresh demand. Okay, so if this is our risk unit, it gave us 3-to-1 risk-reward ratio. Okay, same thing if we would wait for the whole action to end. That will be about just a little bit more than 5-to-1 in range of potential. Again, I'm not saying that we know how to take this, but just think of this as your odds. Okay, we see the reaction, we see that it represents for us what this image representing for us is the potential of buying at the lowest price. Okay, buying at a very accurate low price that will give us significant high risk reward ratio. How about that sell? Decision point, stop loss just above. If this is our risk unit from entry to stop out, at the first reaction, the first approach to that key level, we would sell, and let's see how much risk to reward we had received. Before price had hit our stop loss, it gave us at least 3-to-1 risk reward ratio. Again, I'm not saying that we know how to take 3-to-1 or how to set the target just yet. But this is just to illustrate to you that these levels, these decision levels, are wired, they are hot levels with orders that are waiting to be reacting. Okay, just imagine what happened at the desk. And this is the proof for that. When price is coming to a price where there were unfilled orders, it will react because these unfilled orders are now adding up to more sellers that are joined to this price level. Okay, so that will give us high odds. Again, we're not about prediction, we're not about reversal, we know nothing about what the market will do next. We're just managing risk. And where's the place to best manage risk is at the very tops and the very bottoms. How we pick them? We look for where was that very extreme place where we can find unfilled orders to one of the directions. Okay, so that's the concept of trading. So let's go. Let me read some questions. Do you have some questions? And we'll go on live charts. Okay. What time interval I'm using, what time frame I'm using. Supply and demand works on every time frame. It really depends on what your trading style is, and you can use this concept from a tick chart, 1 minute chart, or weekly chart and monthly. It's really up to you. Again, it's a core universal rule that when there are more buyers to sellers or more sellers to buyers, price will react at that point. So it doesn't really matter what time frame it is. Okay, the decision point is at the bottom of the body of the previous candle or at the minimum of the week. It's not well. Mario, your question is very good. I know a lot of people struggle how to mark right the supply and demand. I can tell you two things. One, it's about practice and finding out what makes sense for you. And second is about just looking and making and trying to make it sense for you, make it so if we're looking at this decision point, we see that price is going down, and we see that now from now on, price is very assertive, very powerful. I can see it with the eye, so I can decide that my decision point on this demand will be right here. I can also decide that this candle is much stronger, and I can decide it's this one. The whole range is full with pockets of supply and demand that we can use. But where would be the ones that are most rewarding? They would be at the extremes. But how to accurately plot them, it's pretty much about looking with the naked eye. Sometimes price would base a lot before it's pushed to one direction, and that's very last bar usually show us where it is. Okay, we'll draw some very soon. Okay, let me read another one. The supply and demand zones is built from the start to the end of the candle. We're trying to wrap the whole price action in there. Remember that candles are not graved in stone. Okay, candles are just a way to register price in time, and time is just it's just an arbitrary unit. We could have a 4-hour candle, we can have a 1 minute candle, we can have 1.3 minutes candle. It's all about unifying a way of writing price in a way. So at the end of it, there's no actual time frame for candles. It's all about price. And because we don't have a better way to actually plot this story, we do it with charts with 1 unit for each, but it doesn't really matter. When price is here at this peak, it's the same price on the 1 minute or because it's H4, so it's the same peak will be seen at 15 minutes, at 5 minutes, 1 minute, 4 minutes, whatever it is. Price is price. Do I prioritize high time frame first? Yes, because, but again, price is price. But I begin with high time frame because with high time frame, I can see significant price moves. But then I would drill down to lower time frame to find more precision and my triggers on it. Let's move on to live candles, live charts. Let me find it. Okay, let's switch that thing for you. Sure. Okay, everyone see my charts? No. You don't see my Canadian chart. Let me do some share. You share. Okay. Can you see my chart platform now? Good. Okay. Sorry for that. So this is the loonie, US dollar, Canadian dollar, and it's a 1 hour chart. And let's start practicing whatever we were discussing now. Okay, very easy to see that price is dropping down very slowly. And let's see what happened every time we're going to, the practice that we're going to do is that we're going to look up for the decision points. We will frame that zone, that supply and demand zone, and we will see what happened once price is back there. All right, so at the very top, we see pricing went up, basing at around this area, and then price, we see that very top peak, and from that on, price is starting a drop. I would say right about the end of this candle, I can see that significant candle that had broken that low, and therefore I will say that this will be my decision point. The risk unit will be just above that wick. So I will stretch that rectangle all the way to the future and see if price had approached this. Not yet. So I will leave it. And this will be my future trade. I will actually sell. Let's do this. I will sell at this very level, whatever it is. For me, the numbers don't really, I don't really mind for the numbers. And my stop loss will be just above this. Okay, it's 9 pips, 9.3 pips range that I've marked. That is my risk unit for this decision point. Okay, we're not, don't imitate me because we're not talked about target yet. And if you don't set your target on a trade, you can be right, but lose that money, because price can give you just a reaction and then come and take your stop. And so you can be right on the market. If you don't know where to exit, all the effort is worthless. So don't imitate me. Let's just discuss the entry and do mine. There is no exit signal here. So don't do this at home unless you do it on a demo account. And okay, so we're just plotting supply and demand area. Okay, now price is going down and basing, and from that basing, it's dropping a little bit down. I'm not very interested in that decision point, although it is, and although it's reacted. You know what, let's just mark it. So we have a decision point right about here, and that would be the trade. Okay, decision point right about this. And once price came back very, very soon after, it reacted to this supply decision point. From now on, we are no longer want to take this zone. It's no longer valid because it was taken. Okay, so let's just mark this. We don't want this anymore. So we don't stretch it anymore because we had that first touch. Next, price is flagging down, coming up. We have this peak, and then price is going down, lower lows. This will be our decision. So let's mark our decision right here, and and this will be our box. Let's stretch it to right to the future. And first time price is hitting this level, it continued to go down. Okay, so price had gave us some drawdown, but our entry would have been right at 1.319693, and our stop loss would be just above. And we see that within that range, we wouldn't be stopped out yet. Okay, next, price is going down and coming up. The decision point would be right about here, and our stop loss would be above this top. So here's that decision point. Here is our risk, and let's stretch it all the way to the future, and apparently now is the future. So we see that when price approaches the first time to this zone, look what happened. Maybe you are seeing a fail here, but I don't. I see that reaction. This, if we go to a lower time frame, let's say M15, we still have that zone created by the H1, but once price had entered, and remember our risk is all the way up to 1.32, price gave us 13 pips drawdown, and then went down about 20 as a reaction. Okay, now it's coming up again into that zone. So this will be the second approach at that zone. That would have this confirmed the second trade. Okay, but the first time price had came in, it gave a reaction, not a pretty one, but it gave a reaction. The market is reacting to the law of supply and demand. Let's continue. Okay, then price going down, rallying, and then it was breaking down right about here, I would say, and then very quick it turned up. Okay, that I don't know. It's a little bit messy here, but if we would look at that decision point after price went down all the way and price went in here, that trade would have worked for us as well, even though it was very quick back to the zone. Okay, now these bars are very, very long, so we'll need to, in order to find something to drill down, we'll not do it right here, but then price is coming up and we have another decision right about here, and our risk will be here. We stretch it, and then once price coming back again, very precisely, price is reacting to that supply and demand zone. Once it was touched for the very first time, this is no longer valid. Same here. And same here. Okay? And we can continue like this on and on. Again, here's the decision point, here's the risk. Let's stretch it all the way up. Now we were, I believe we were busted for the first time. Okay, right about here. Okay, this trade we would sell right here and we will take the full stop. But see how many trades did work. It did give us a reaction. So for me, it's very good lesson for you to see that what I'm teaching here, it's not graved in stone. Supply and demand are just levels like any other level, and levels will break. Sometimes they break faster, but this is to show you that trading is about risk management and not about prediction. Rules are never 100% proof. Okay. Now let's investigate some demands, because we can plot more and see how they work out. Right here, we see the reaction again, and right about here, another supply right here. Here we would be busted again, so no work. And now let's change the color. We have a decision point for price to go up. We're stretching all the way to the future, and it's not there yet. So what is going to be? We are going to buy limits here. And leave our stop just below this one. Okay, and we will wait for the first approach to this level to buy. Again, a disclaimer, very important one: do not imitate what I'm doing, because we're not discussing the target. If you don't have target, the whole effort is worthless. Okay, if you don't know how you're going to exit this, price is choppy all the way through, so don't do it. Okay, now here we were busted, but demand was created right here. Price came on the first approach, faked out and continue. This trade would have not worked, but the analysis did. Sometimes the analysis worked, but not the trade. Actually, it's the most of the times. So this trade would have been busted. There's no demand right here anymore. Okay, and trade busted. Next, we have a decision point right here, and our stop will be here. What happened when the price came for the first time? We get our reaction right here. Okay, here's another demand decision point right here. Price coming to here, spiking up, giving us much more, I would say like 5 times the risk from here. It's amazing. This decision point is maybe it's nice, maybe it would have worked. I don't know, it depends of the chronology of where is it? Let's mark it. Decision point right here. It's really important. It was very, very, I don't know if we would have time to actually plot this, because nothing significant had happened, and we don't know what happened, if price went down to lower lows and then ended up, or it was going up then coming to that level. Anyway, I don't think we would be able to have this zone plotted before price had went down there. There is a decision point here, but it was taking already. So I don't think we could have taken this trade anyway, or find this zone before it was already busted. Okay, so price went up. Here's another supply decision. Price is right about here. Price was almost touching here, but not. Usually I would disvalid the zone if it was very near and reacting, because I don't know, maybe the pockets are just here below. I would disvalidate this, but if we would have stretched this all the way through, it gave that reaction, that expected reaction after all. Okay, so another demand. Here's the decision for price to originate higher highs. Let's make it more precise. And price on that neck, and price hit this and continue. So you can see that supply and demand is very effective when you are trading on a trend. When price will reach back in here, in this demand, we would theoretically want to buy here. I'm saying theoretically because risk-wise, it's not the greatest idea because it's on the middle of the range. But for the sake of education, this would be our trade. Buying with a limit order at the decision point, having a risk unit all the way below that that last trade that have created that zone. That will be how we actually plot supply and demand. Okay, so let's take some questions, and then I'll tell you how I would suggest you to move on forward with this information. Okay. Okay, questions. Let's decide that questions are on the chat, not on the question panel. So I'll know where to look at. Shouldn't the box be in red as in supply and demand zones, and blue for the buy zone? Yeah, Kosh, it's the right thing to do. If you want to signal yourself with coloring, that's even better. Actually, I do apologize. I was thinking of doing different colors for supply and demand. I should have done this because we're doing education, so I'm sorry for being lazy for not doing so. But you're very right. When you're practicing, draw supply and demand with different colors. You know what? Let's do it right now. Let's just change these colors. Whatever colors you decide, it's okay. There's no convention here, as long as you understand what the colors represent. Okay. So we have demand, and we leave the supply green. Okay, so here's more demand. We'll pick blue. Okay. Two more, and let's not waste too much time about this. Okay. Okay, thank you for the feedback, Coach. More question. When marking the zone, why did you use the close of the red candle body and Okay, like I said, it's trying to make sense of the story that you see on chart. When I see a significant, when I look at the chart and I see where is the significant move, I would look for whatever it has to break in order to continue and make some significant breaking other levels, breaking the opposite level. In this case, creating lower lows. Okay, so where would that be? Graphically, I can see that this is the candle. So I would pick up the close or the lowest to be more confirmed, more conservative on this. And this is where I will decide where to put that decision point. You can be also more conservative than that and say, okay, that's low of this week. Let's make it bigger. Where were we? Okay. This low is also something that price had to struggle to push through. So maybe that can also be a decision point. Yes, it is. If you make a reason with it, this is also can be a more conservative entry point. But I would like, when I want to sell, I would like to sell as high as possible with the highest price as possible. I want to be the smartest seller on the market. So, so I wouldn't take the most conservative entry, but that may cost me sometimes missing these trades. Sometimes price will react here below my entry and not give me that trade. So this is the balance where you have to decide what kind of risk appetite you want. However, when you take this trade, you would have much larger zone to risk. So whether you recalculate your risk percentage or you take it by pips, with both methodologies, you would be struggling if price going inside your zone. You would be spending more time experiencing drawdown and all the emotional consequences of this. That will be much more time that you spend with a drawdown on this. But if we mark this decision point, see how price had reacted to this as well. So you can be conservative, catch more trades, but the downside of this is that you would suffer more time in drawdown if the trade goes against you, and that can wear you out. Okay. Eshob, I don't really understand what specific you're referring. He's saying that there are essentially untouched supply and resistance zones that haven't been touched since the candles used to draw them. Well, you probably were discussing specific. I cannot replicate this at this moment. Okay. Yeah. Ashish Tuli say it's very similar to support and resistance, and this is a very important topic. Thank you, Ashish, for bringing this up. A lot of people mix support and resistance with supply and demand. Although they are both discussing key levels in the market, I think the advantage of supply and demand is that with supply and demand, you have a definition of your actual trade in terms of your risk as well. You know how much you have to risk in terms of price action range, where with price action, there is not much definition for how much price can penetrate and how much you would allow price to penetrate against you before you take the stop. Okay, with price, with supply and demand, we give a reasoning while trying to interpreting price action or decision levels for assuming where we would find unfilled waiting orders pockets that will react in the future. Where with support and resistance, you would be looking at the extremes and see if these extremes are actually reactive. Supply and demand will tell you much more than that. It will tell you if you will have to attend more the other parts of this seminar, but to know that with supply and demand theory, we will discuss also where there are no supply and when there are no demands. The same way that we've created where there is supply or there is demand, we can also analyze where there are no pockets, where there is no resistance on the side of supply and demand. And one tool we've already acquired in that sense is after price had already visited that specific level. Once it was touched that level and reacted, the next time we don't know anything. We don't know what is the balance of the orders out there. So therefore, we know how to prevent ourselves from taking the wrong trade. While at support and resistance, this information is not available, at least as far as I understand support and resistance. Let's see. Okay, so I think we're about to wrap up today because we've covered the basics. And let's recap. And I'll give you some practice for the people that want to practice this. And actually, I urge you to go on a demo account. Don't put any trades. Don't think you understand, because there's much more to dive into this particular theory. But if you do it with this very simple concept and do it only on a demo account. But the most important thing that I want you to do this week is to actually go to the charts, whatever chart, find these turning price action, find yourself, train yourself to plot the rectangles at the decision point and find the risk zone and define, and then stretch it all the way until price has met this. Go to the history and see the consequences. Find the decision, stretch it all the way through once price had hit it for the first time, so you will have the feeling of what to expect when you're going to be trading real time with similar knowledge. Okay, so your practice is to go, just close this. If you go do a MetaTrader, just turn off the auto scroll and go all the way, as much history you go. Any time frame goes, any time frame works. H1, daily, monthly, 1 minute, whatever you have enough history, go and start marking level. See significant rally. Try to think, where was that decision for price to go to start that rally, and mark it. Here's the decision point. Stretch it all the way through and see what happened when price had met that price for the first time. Did it take my stop? Did it make a reaction? Yes or no? Do this over and over and over. Practice your eye to see these. Here it wouldn't have worked. Okay, again, here's a supply that wouldn't work. Maybe a reaction was here, but very, very tiny one, but there was. Okay, here's a supply that did work, right? Do this practice on charts. I think most of you would just love it. It's really fun, and but the best reward from it is that once you do it and you have created as much as zones as possible, and you see what happened when price returned there for the first time, you would have an insight, an insightful view of the market. And this is the greatest thing about learning new stuff. So this is the homework I expect you to do. So if you feel that you're interested in this, um, um, and uh, and for the next sessions, we're going to discuss more in depth about supply and demand in different variation. We will look up what happened after a zone was broken. What is happening there, and what does it tell us, and what can we expect with these zones? What happened with them? What happened with this information? We will discuss where we can find no resistance, no supply, no demand, and we will eventually will be able to make a trade assessment where we would want to trade with one with the market side that have the power. Let's say the buyers have the power versus the no seller zones. We would learn to spot these areas, and this will give us extra edge on reading price. So if you sign up for the next 5 sessions, we will cover a lot of information, a lot of in-depth information. I promise you that for every session, we will begin with the very basics. We will start by plotting supply and demand, the very basics, and we'll move on to the deeper stuff. So let's just recap and return to the, where's that? Okay, so let me recap why I like supply and demand order flow. First, because it's the core reason for why price is changing. Because it is a timeless logic. It's a core reason for why price is changing. Nothing can manipulate this. Even the high time frequency, the high frequency trading industry, the traders, the big traders that can cause movement in the market, they are also subject for the supply and demand. They are using the supply and demand theory because they know how to inject a lot of liquidity into the market, and by that moving the market. They understand this, and we need to understand what they're doing, because we are just riding waves, and they're creating them. But we would understand better where are these levels, and they are also subject to these levels. They are playing on them. They are deciding how to break them, because they know that when they are coming to a key level, they need to inject a lot of orders if they want to penetrate these levels. And if they do want it, we would see signs, early signs for this, and that is our job to do. And so it's timeless logic, worthwhile to learn. And as long as the market is liquidated, we're good. It works on the micro and micro. You can see the same behavior of price on H1, on daily, on monthly, on 1 minute, on tick chart. So it's just amazing. Do so this week, and you'll be amazed how it's worked. And the best thing about supply and demand, it's actually once you mark these levels, you actually have the trade itself. You have the trade, you have the risk, you have the entry, and you would have the exit. Not today, but in the next session, we'll discuss the exit as well. So understanding supply and demand, you have it all. You don't need to just bet on X amount of pips or specific a portion of your account just because you have a signal to enter. You have everything. You have the full structure for what to expect from the market. And the best thing is that it gives excellent risk-reward ratio, and it gives us the something that I don't know why on the financial markets, a lot of people would prefer to buy expensive and sell at cheap. We wouldn't want to do it with anything else we do in life. We always like to buy at discounts. We would never go and buy our house very high. We would want to negotiate the price first, okay? But in the financial market, so many people just looking at price rising and they would buy the most expensive one. The supply and demand give us the time and the patience to wait for price to come to us, and we're not chasing it. Price is coming and approaching whenever it is it's approaching to wherever we've decided to trade. So we have the control in the market. We have the decision where and on what price we want to react. And this gives us a lot of odds, and we receive higher risk reward for that. And the best thing about this, it's so easy and simple. You don't need to have your charts with full of indicators and things that blinks and I don't know what, and flash and everything. It's very, very simple. Price is price. And order flow, imbalance packets are there to react, and we are here to take it. It's that simple. No secret, nothing. This is all about, I can tell you. So, I'm Gil from the Farmers. We found Forex traders. Enough being commercial. Thank you so much. Come next week, same time, Tuesdays, the next 4 Tuesdays ahead, we're going to cover more in-depth stuff about supply and demand theory. We'll put it into practical ways to trade and to manage risk and to manage mentality, and we'll know how to do it best. Hopefully, I'll scratch your curiosity. Go and learn this vast amount of information about supply and demand. Go and learn, go and practice. I'll see you next week on Tuesday, same time. Take care and high five, everyone.